Investing in securities like shares, debentures, bonds can be exciting and profitable, but it also comes with risk. A famous investment rule says don't put all your eggs in one basket, meaning you should invest across different securities to create a diversified portfolio. But the question arises, can you, as an individual, diversify your portfolio in an optimized manner to reduce the risk and maximize the gains? By staying tuned to the video till the end, you will definitely find your answers. Now, one way of diversifying your portfolio is to invest through mutual funds and index funds. But the issue here is they do not guarantee you the returns. The returns in mutual fund depends on the expertise of the portfolio managers. So the other way is you can diversify the portfolio by yourself by creating one. For that, you need to understand that there are two types of securities. One is debt funds, and the second one is owned capital. The debt funds are the bonds and debentures, which are considerably the safer investments, and the other one is equity shares. And by investing in equity shares, you own a part of the company and you become a part owner. So, by creating a mix of debt funds and equity funds, you can make a diversified portfolio. But before making a diversified portfolio, you need to understand the risk involved in investing in shares. Basically, there are two types of risk. One being the systematic risk, which affects the market at large and is caused by the external factors such as global financial crisis, political distress, inflation, etc. And the other one is the unsystematic risk, which is company specific risk and is caused by internal factors of the company in which you are investing. Let's say because of the management of the company or the cash crunch of the company. So, as an investor, you can control the unsystematic risk, but systematic risk is not what you can control. So, we will focus on controlling the unsystematic risk, which is the internal risk of the company. By diversifying in multiple companies, you can reduce this unsystematic risk up to a certain level. Now in this video, we will understand the portfolio risk and how to create a minimum risk portfolio with the help of number of two securities, and you can do the same process for multiple number of securities. Let's understand a few basic concepts such as expected returns, variance of return, standard deviation in return, that is average risk involved in expected returns, and covariance of returns with the help of two securities, say X and Y. Starting with expected returns. Expected returns is the average return that a security generates over the period. Let's say company X generates 20% in the first year, 16% returns in the second year, 30% returns in the third year, and 6% returns in the fourth year. The expected return of the company X will be the summation of all these return percentages divided by number of years, and we will get expected return as 18%. That means company is expected to generate 18% returns per annum. Now, you may see that there is deviation in the returns. In first year it was 20%, in the second year it was 16%. There is a fluctuation of 4%, right? And by end of fourth year the returns were 6%. There's a major fluctuation here. So we will have to find the average risk involved in investing in X. So we will find the variance. Now, variance is the deviation from expected returns. So, for that, we will find the returns less expected returns, and we will square the whole. And for that, the x minus x bar will be 2 minus 2, 12, and minus 12, right? So when we find the variance of it, it will be 4% square, 4% square, 144% square, and 144% square. And the total summation of this divided by number of years, that is 4, we will get the variance of x coming to 74 percentage square. I know it might be a bit confusing at first, but once you get to know what is standard deviation, it all will get clear. And the standard deviation is nothing but the root of variance. Now, what is standard deviation? Standard deviation is the average risk. By doing the root of 74% square, it comes to 8.6023 percentage. It means generally there is a deviation of 8.6 percentage from the expected returns per annum. It means you can expect the returns to be fluctuating between 18 less 8.6 percentage coming to near 10 percentage to 18 plus 8.6 percentage, that is 26.6 percentage. So it would be in the range of 9.4 percentage to 26.6 percentage. This is the range of expected profit. And we will do the same for company Y. We will first find the expected returns, then we will find the variance of the company, and lastly, the standard deviation. Now in this process, we will add one more column for covariance of the company. This is the average risk when both the shares are combined or taken together. For this, we will multiply the x minus x bar with y minus y bar. And the summation of x minus x bar into y minus y bar will be divided by the number of years, which comes to 37% square. One thing you have to note here is we will not root this number. Covariance is in terms of percentage square. Now, when you know what is average risk, that is the standard risk, right? Standard deviation, we can find the portfolio risk finally. So, the formula for portfolio risk is weight square into variance of x plus weight square into variance of y plus remaining weight into covariance of xy, the whole root. So in our example, we will get portfolio risk of 6.452 percentage. That means if we have invested in the security X and Y, we will be facing the risk of 6.452 percentage in our expected returns. So our basic requirement was to find optimized portfolio, optimization of diversifying in portfolio, right? So for that, we will calculate the minimum weight that should be allotted per security or maximum weight which we should allocate, right? So to calculate the minimum risk portfolio, we have the formula of weight X and weight Y. That is how much we should invest in X and how much we should invest in Y. For weight of X, we will divide the risk reduction of Y by risk reduction of X plus risk reduction of Y. Simply, it means variance of Y less covariance of XY divided by variance of X plus variance of Y less 2 into covariance of XY. And for the weight of y, we will subtract weight of x from 1. And by this, we will get our optimized weights of x and y to achieve the lowest possible risk. And applying the formula, we will get the weight of x as 0.5, that is 212 divided by 425. And weight of y will be 1 less weight of x, which is also 0.5. It means that for creating an optimized portfolio with minimum risk, we should invest 50% in company X and 50% in company Y. This will give you the minimum risk portfolio, and you can apply this process for multiple securities as well. And this is how you create a minimum risk portfolio by diversifying in multiple securities.